It's getting to the time where we start looking back at the year that was and to the year that's coming. Are you looking to see more gains next year in 2018 from this bull run, or should we be anticipating a bit of a pause at this point?
Well, look, I think there's no doubt that 2017 has been a spectacular year. Our view has been it would probably run into 2018. Our price target of 2,700 was always a first quarter 18 target. We're making progress towards that. I think, though, beyond 2,700, maybe 2,750, it's going to be hard to get much above that in 2018 for a couple of reasons. So 2018 should be fine economically. We're not looking for a recession. However, the rate of change on earnings growth will likely peak at some point. And I think, importantly, financial conditions are likely to tighten next year, whereas this year they've been extremely stimulative. The missing ingredient, the final piece that probably has to happen for us to make a kind of a cycle top, is we still have not yet seen retail investors come in any meaningful way, sustained way. And I do suspect we'll see that before it's over.
Can we at least say that the correction that we're looking for is over with the recent pullback?
Yeah, so, back in October, we felt like the market had surged a little bit too quickly into earnings, and so we were looking for some corrective activity. We got it in some international markets. As you know, we saw Japan and Europe trade off 5–6%. The banks came down about 5 or 6%. Some of the more cyclical areas came down, but the S&P really never really came down more than 1%. I'm not sure that we're totally out of the woods here, that the market doesn't have one more trick up its sleeve. But either way, it's a correction within this bull move towards 2,700 plus.
So what do? Do you get out and wait out the correction in some other asset class or in no asset class, or do you just do you stay in there and sort of look for places you might rotate into?
Well, look, I mean, we've stayed fully invested through the entire 2017. We've not advised people to try and trade any kind of near-term correction. All we've told our clients is, look, in October, this is a point where maybe you just take a little of a breather. If you have a dollar cost averaging, maybe you wait a little bit to put money back, accelerate that dollar cost averaging. But look, the bull market's very much intact. I think the things that we've been looking for this year are playing out in spades: accelerating earnings growth, very stimulative financial conditions, sort of sentiment that is not euphoric yet. And those are conditions for a bull market, and that's what we're having right now.
What about dividends and buybacks? They were part of this rally that we saw. Now we're seeing capital returns slowing a little bit. Is that a concern?
Yeah, we wrote a note this past week actually about capital return and sort of how things have played out. Look, in the era of quantitative easing, there's no doubt that share buybacks, even M&A, things that are easily to accrete to earnings because the cost of funds are so cheap, have played out. In other words, companies have acted very rationally with very low cost of financing. But now companies need to find a way to grow. And so we're actually seeing cash now be redirected towards capital expenditures in an effort to either increase productivity, to reduce costs, or to generate more organic growth. And that's classic late cycle behavior, which ultimately will lead to margin pressure at some point next year. But right now, it's actually a positive for economic growth.